So what I really focus on, again, what I did was I kind of threw you under the bus, right? Act like your boss. I need you to write a memo. Here you go. I don't know how to do it. Figure it out, okay? And then get back to me at the end of the week. That's how it's going to work. And here's an example of a memo that we just wrote up. This is the template. Just use it. Now go do it. That's kind of how they do it. Okay. So the key, excuse me. So the key to it is really replicating the format, because nobody's going to read your memo if it doesn't look right. Okay. So everything's in the format. Okay. You're missing a period. Maybe it's not in upper and lower case in the RE. The margins are off. The memo font at the top is not bolded and it's not large enough. I mean, these memos got to look beautiful. They got to be perfect. Once the person scans it, sees that it meets the format, they're going to read it. Okay. And then usually your managing director, if you're lucky, which is me, will sit down with you. This is what happened to me. Excuse me. This is what happened to me, and I was super lucky in my career because the first person that I got to work with was a professional writer. He was writing all the investor relations, for our firm, did all the publicity stuff, did all the marketing, did all the write-ups to the investors, did everything. So he sat down with me and showed me how to write and how to do, these professional memos. And then I worked with two other bosses, two executive vice presidents, that basically did the exact same thing and sat down with me and basically helped me with my writing and my formatting skills. And one of the second firms that I worked with, if you're lucky, you'll get this. They actually hired a writing professional to come in and train me on how to do these types of memos. Okay, so I was really lucky. And then it took me about, hopefully you'll get where I got now, not 7 years. It took me 7 years to become a great writer. 7. Okay. So work on your writing now so that you become a great writer now, so that you don't have to go become a great writer. You're already a great writer, and it'll make your boss's life so much easier to know that you can write this content. You can bring it back in almost publishable form. They just give you some suggestions. We edit it. They'll look at it again. Boom. They'll publish it. So we're going to go back and forth on these memos until all of them are perfect. And I'll reread all of your memos probably, if you're lucky. If you work with me, I'll read them at least 15 times. Okay, I'll scan them every time to make sure they're perfect, so that when they're done, there's really no errors in them. Okay, and then the two websites, bigcharts.com. I like big charts, or stockcharts.com. That's a good one too. You can go up there and type in, what's Apple's ticker symbol? I can put that in. Here's the Apple chart right here. What I like to do is I go down here where it says fill the chart right there. I click 3 years, and then I use a 10-day. This is what I use for all my classes. I use a 10-day, 30-day. Average right there, and I use a 50-day, and then I update it. Why do I do that? Well, now I got the chart with all the technical analysis in it that we went over. We didn't go do technical analysis, did we? I still have to do that with you. So now I got the chart. I can just right-click it. I can copy the image, and I can paste it into a text box or paste it into my Word doc. Okay. And I like the 10, the 30, and the 50-day moving average, because you can make money off of this. Did you hear what I said? You can make money. This is a money machine. It'll make you 10% rate of return guaranteed on 25 stocks that you're trading. So all you got to do is every time the 10-day crosses the 50-day, that's your sell alert. And then when the 30-day crosses the 50, that's your sell signal. When the 10-day crosses the 50-day, that's your buy alert. And then when the 30-day crosses the 50-day, that's your buy signal. You just do that, you'll be a millionaire in like 10, 30 years. It's a very simple system. It works. I back tested it, and all my students use it. If you invest $1 million, this is what we did. We invested $1 million, hypothetical, $1 million, implemented this system on 25 stocks. They made $100,000 a year. Every year, $100,000 on $1 million. Guaranteed. Or if you become crazy, then forget it. Just use it for the memo. So So just right click and copy it in there. Also on the site, if you go back, there's usually some headline news up here somewhere. It's going to be in there somewhere. I know Big Charts has all the news right here. Obviously, you can go to Yahoo Finance, and there's going to be news there too. Basically, you can take those news, click on those articles. What I would do is go find the analysis that basically says the Dow Jones Industrial Average rose from 25,000 to 26,000 since January, up 26%. Boom, you're an analyst. You can take some of those captions from the different articles, copy and paste them into your memo, edit them down so that you don't get accused of plagiarism. Okay, go to big charts, go to stock charts. That's where you get the graphs. Where do you get the data for these things? You got to go search. You know, you can use the internet. You can use Yahoo Finance. You can use stockcharts.com. You can use Bloomberg. You can use Thomson Reuters. You can use the Financial Times, the New York Times, the Washington Post. You can use the Wall Street Journal. There's all kinds of sources out there that talk about the stock market, oil, gold, bonds, and currency. Okay, so that's you guys are doing good. You're right on track. So if you clean up your memos, bring them back on Monday. I'll take another look at them, and then if you want, come see me or spend a little time with me after class, and I'll read your memos and give you some editorial comments. Okay. All right. So where's the stock market right now? Where's the Dow?
0.5%.
Yeah, and give me a number. How many points?
130.
How much?
130.
130?
Yeah.
Okay, is that a lot? That's pretty much in the noise range. If it's up or down 250 points, then I'm really scared. Okay, where is the barrel of oil right now?
Down 68.
Down to 68. So what was it? Wasn't it hovering around 70?
Around 70.
So now it's coming down. So it's either coming down either because of increased supply. I think the Bush administration was pressuring Saudi Arabia to increase the spigot on oil to try to bring down oil prices so the economy doesn't go into a recession prior to the congressional elections in November, because they want to win back the House and the Senate, and then definitely not send the economy into a recession prior to the 2020 election, presidential elections. He definitely doesn't want a recession then, and that's why he's pressuring the Fed to keep interest rates low, and the Fed saying we're going to still jack interest rates another 4 times, 25 basis points each within the next 12 months. So this is the reality. And then where is gold right now per ounce?
1209.
1209. It's still pretty flat, isn't it?
Yeah.
I mean, it hasn't really done anything. Okay, I looked at the numbers. Gold prices are up over the last year, but if you go back 3 years, it's basically been flat. It hasn't done anything. And then where's the yield on the 10-year Treasury bond today, which is the benchmark interest rate where all cost of capital is basically priced off of?
295.
What is it?
295.
295. Where was it? Is it up or down?
It's down.
It's down. So if interest rates are going down, then what's happening to the bond prices? Test question. You got to know this. If interest rates are going down, the bond prices go up. Up. Got it. So if interest rates are going down, give me one reason that would cause interest rates to go down. Or give me 2. What would cause bond prices to go up? Higher demand or higher supply? Higher demand or higher supply? Higher demand. Got it. So there's more demand for bonds, pushing bond yields down. What else would drive bond yields down using the Fisher equation? The Fisher equation, what would drive bond yields down? What's the one variable that would drive bond yields down? You can look in your notes, you can go on the computer and look it up. The chapter, if you read the chapter, which they're going to present today, is in the chapter. What's the #1 factor that drives interest rates down? No. Using the Fisher equation, what's the #1 factor that drives interest rates down? You guys should be all on your computers looking for the answer.
Lower inflation?
What?
Lower inflation?
No, lower inflation what? Is it inflation or give me the technical term?
Rates of inflation.
Lower inflation expectancy?
Lower inflation expectations. Lower inflation. Give me the dollar to the pound. Dollar to the pound. What is it trading?
1.13.
pound?
The pound,
Is that the euro or the pound?
the pound,
Is it? 1 point, it cost me $1.13.
31.
Oh, got it. I thought you said 13. Yeah, it's $1.31, right? And is it up or down?
It's up by 0.50.
So it cost me more
Yeah.
by a pound? So did the dollar appreciate or depreciate?
Decrease.
Excellent, nice job. And then the pound did what? Appreciate or depreciate? Say it?
Appreciate.
Perfect. You all need to know this logic, okay? It's a game. Business is just a game. It's built, on rules, linguistics, logic. If you know the rules, you know the game, you know the language, you can answer people really quickly, you're gonna excel, okay? If you struggle, and you don't know it, they're gonna ask you questions, and if you don't know the answer quickly, they'll find somebody else who does, okay? You'll learn the hard way, okay? So don't learn the hard way. Learn now, make it easy on yourself. I highly encourage you to sign up to take the SIE exam, okay, to get in to these financial institutions. It's a great place to go. I also sent you today, I spent some time writing up some of the calculator procedures to be able to calculate net present values and internal rate of returns using the 3 financial calculators that I recommended. So you can look at the procedures, you can practice them, and if you still have a hard time reading my handwriting, reading my logic, I tried to make it as simple as possible. You can always refer the financial calculator manuals that are posted to the website. So you have all the references there for you. What else? Anybody else want to do the extra credit problem set? Extra credit problem set? I have some extra copies here. And the solutions are up on the website. So it's just a way of practicing solving some of these problems, okay, and not getting stuck. I don't want to waste your time. I don't want to waste your time having you struggle to figure out these problems. Why not just use the solution? That's probably what's going to happen when you when you go work somewhere.
It's an extra.
Okay, when you go work somewhere, they're going to say, "Oh, here's the problem. Go find the solution." They'll probably have the solution somewhere. You just go find it, and then you learn it, you apply it, and then you solve it, and then you present it. And that's how I did it with how I did it when I designed the indexes for Schwab. I've never built indexes in my life. So I went and studied up on how indexes were constructed, and then I actually went to my operations research supply chain management course, got my ops book, and did all of the inventory control system based for the data based on my operations research books that I took in my class. And I built the data processing around a manufacturing environment, just like building a car. Have I ever built a car? No. Do the ops manuals and the manufacturing manuals show you how to build a process and basically a car? Yes, they do. And I just replicated it, and then we implemented it, and it worked. Okay. Just so little tidbits. So on Monday, bring me the, if you're still working on the pre-test, let me take a look at it, let me take another look at the memo, and then bring me your resume so I can take a look at the resume too. So who's going? We have 2 presentations, and then I'm gonna start working through the exam, okay? Because I basically finished almost all of the exam, except for the problems, in the other class. Okay, so let's see if we can catch up to those guys. And then I already did send you the lecture from the second section. After every class, I send you the YouTube videos. The second section's YouTube video goes all the way to the intrinsic valuation method. Or actually, I think we went as far as the technical analysis in the last section, so you already have that. And then we'll do the valuation, intrinsic valuation methods, and then we'll start doing the problems, okay? We should be done with all of the exam by next week, and all of the chapters. So then you're ready to go, ready to take the exam, okay? All right, so when you guys are ready. And I'll probably start writing some stuff up on the phone. that through modern portfolio theory and derivative trades last time. And I just need, we didn't do technical data. Thank you.
So we're doing discounted cash flows and valuation. The learning objectives are to explain why cash flows occurring at different times must be adjusted to reflect their value as a common date before they can be compared. You guys can kind of just read the learning objectives. We're just going to go over them in the slides. So you guys don't really need to read them through. So future values. So you're going to draw a timeline. And it'll be on this next slide, to determine the number of periods for which cash flow will earn the rate of return that you've projected. And then you're going to add the future value, so that's what this is right here. So you're projecting out 2 years, or 2 cash flows, but it's 2 years. And it says that you're forecasting that it's going to be a 10% annual return. And then the total amount of the savings is $2,310, which is the sum of the future values of the 2 cash flows. And then, so this would be for a third year. So you do the same process, and then you'd end up with $3,641, which is the sum of the future values of the 3 separate cash flows for those 3 years.
Now moving on to cash flows and the present value. You're going to draw a timeline to see the magnitude and timing of the cash flows, and you're going to add the present values. So you see here, you're adding the present value for each year. Then,
So first, an annuity, a series of equally spaced and level cash flows extending over a finite number of periods. Perpetuity, a series of equally spaced and level cash flows that continue. Ordinary annuity, cash flows occur at the end of a period, including mortgage payments, interest payments, and annuity due cash flows occur at the end of at the beginning of a period, and it includes leases and car insurance. Present value of an annuity, it's the current fair value or market price of the annuity and the amount of a loan that can be repaid with the annuity. And then here's another example.
So this part's important right here. If you guys have your financial calculators with you today, then this would be it. If you don't, what you're going to plug in is 3, 8, 2000, and then you're going to solve, and, and it should pop up as the present value is $5,054.19. So financial calculator does that all for you, what you saw in this last slide. So you're going to get the same answer between the two.
loan amortization is how borrowed funds are calculated over the life of the loan, and then each payment includes less interest and more principal. And the schedule shows the interest and the principal in each payment. As you see here, is a schedule with the interests and the loans and the years. And here is a table, an Excel document.
Finding the interest rate, present value of an annuity equation can be used to find the interest rate or discount rate for an annuity. Determine the rate of return, solve for I, and calculator use or trial and error. Another example. You already need that. Okay.
Basically, there's multiple ways to solve it. You can use Excel, and you can also use a financial calculator. I'm sure that we're going to be able to use a financial calculator on our test. Hopefully. All right. All right. This would be the future value of an annuity that Nick just talked about. And so this is an example of that. So future value is what you're projecting the money to be worth at that point, and so that's one projection. And then the present value is you're using the present value of your money and then forecasting. So you're getting two different numbers, and ideally you're going to end up with the future value, but in all honesty, you're probably going to end up with somewhere between the present value and the future value when you do your calculations. That's why those two numbers are important. And this is another calculator example for those of you following along with the financial calculator.
On the perpetuities, perpetuities are a stream of equal cash flows that go on forever. Preferred stock and some bonds are perpetuities. And then here's the equation for present value of a perpetuity and present value of an annuity equation. And then here's an example of the perpetuity equation in use.
Present value of annuity due, the cash flows are discounted for 1 period less than in an ordinary annuity, and the future value is cash flows earn compound interest for 1 period more than in an ordinary, and present or future value of an annuity due is always higher than that of an ordinary that is otherwise identical. Here's another example. Another equation.
Again, the only difference between future value and present value is what is worth today, and future value is what you're projecting it to be worth. So that's like why you use the different equations back here. So the cash flows are going to grow at a constant rate for the most part, especially in annuity. And so you're going to try and project out what an annuity might be worth at the end of a finite number of periods, and this would be the equation that you'd use. It only works when the growth rate is less than the discounted rate. So I guess would be a pretty good example. So they're talking about a coffee shop, and the cash flow from last year was $300,000, and it increases by 2.5% each year. The discount rate for similar firms is 15%. And this would be the present value annuity at the end. Can't see my cursor, never mind, I'm not going to circle the cursor.
So moving on to the cash flows that grow at a constant rate. We're talking about growing perpetuity, equally spaced cash flows that increase in size at a constant rate forever. And then here's the equation to find the dividend. What the dividend is expected to increase at a constant rate. And then here's an example of that equation in use.
So the effective annual interest rate. Most common way to quote interest rates is in terms of annual percentage rate, and it does not incorporate the effects of compounding. And the most appropriate way to quote interest rates is in terms of effective annual rate, which incorporates the effects of compounding. And the annual percentage rate does not account for the number of compounding periods or adjust the annualized interest rate for the time value of money and is not a precise measure of the rates involved in borrowing and investing. So it's basically the periodic rate times N. And here's another example of the previous equation.
This would be the appropriate rate to use would be the effective annual interest rate that Nick just mentioned previously. And this would be that equation, kind of an important one. So this would be an example. She's charged 1% interest when she borrows $2,000 for 1 week, and it's a weekly rate. What is the effective annual interest rate on the loan? That's why the 52 is to the base the 52 because there's 52 weeks in a year, right? If it's a daily rate, then it's 365. If it's a yearly rate, then it'd just be 1. And you're gonna have 67%. That's the annual interest rate. Makes kind of sense. Another example. This is 1% per month, and so that's why it would be 12 instead of 52 this time. And your rate is going to be 12.68%. It's the same equation. It's just your period and your percentage per month. The consumer protection and information. There's a bunch of acts that have been put into law that require honesty with consumers so that not only is our information protected, but the company's information is protected and we have access to it in a way that allows us to invest and do it safely and not be kind of scummed out of our money by a company that's lying to us. And none of that was our information, so copyright. Alright. You guys just gonna go after this. Go after this. This is you guys. Chapter 7, right?
Yeah.
There you go.
Did you have any other problems? Don't put your
Alright. We won't. I'm trying to duck out. Sorry.
On here?
No. You're nodding.
Solution.
Ah, yep. You know what? I did chapter 7. I read chapter 7, alright? I didn't do anything. No, you're right. I didn't. Yes, it is. Does anyone have the homework problems pulled up for chapter 6? You know which ones we need to go over with you guys? 6.2. Self-study problem, right? 6.2. So your grandfather has agreed to deposit a certain amount of money each year into an account paying 7.25% annually to help you go to graduate school. Starting next year, for the following 4 years, he plans to deposit these amounts into the account. How much we have at the end of 5 years. So this is a future value equation. So that's a problem. So that's the equation that you're going to use, and this would be the just like number lines help you lay out the money so you can see it visually. This would be the percentage. Here's the money going into the account over these 5 years, and you're going to multiply it by that percentage, right? And it's with a 1 in front because if you multiply it by 0.0725, you're going to have less money. But right, okay. And then for the fifth, for that first year, because you have 1, 2, 3, 4, 5, so it's going to be 4, 3, 2, 1, and then that percent, that rate is going to be to the 0 power, which would make it 1. So that's why this last number, 12,000, is just 12,000 over here. And then you're going to add those up to get $40,000. $40,800. What was the next one? 6.5, I think.
5.
So this would be a present value because it's expecting annual payments of $34,225 for the next 7 years from the customer. What is the present value of this annuity if the discount rate is 8.5%? So you use this equation because it's annuity and its present value that we found in the slides. So the annual payments are going to be $34,225, and you're going to multiply that by the interest would be, well, the discount rate is 85%, so it's 1.085 because again, if it's 0.085, we're going to have less, and then it's over 7 years, that's why there's a 7 there, and 0.085 at the bottom, and then do the math. Go over one more problem with you guys.
7.
7, right? So here we go. An investment opportunity requires a payment of $750 for 12 years, starting a year from today. If your required return rate is 8%, what is the value of the investment to you today? So this would be a present value annuity equation that you guys saw in PowerPoint. You're going to plug in the numbers. The annual payment is $750, right, for 12 years. Number of payments, 12. Again, 12 years. The required rate of return is 8%. So you're going to solve 750, 1.08, again, needs to be greater than 0, or greater than 1, and then 0.08, solve for it for $5,652.06. Hope that kind of helps. We went through it really quickly. So, thank you guys. Chapter 7. Unless you guys have one.
Alright, so we're doing chapter 7, the fundamentals of corporate finance and risk of return. Yep. And so these are all the learning objectives. There's a lot of them, so we won't really go into them since that's what we'll be going over on the slides.
Okay, so the risks in return. The rate of return that investors require for an investment depends on the risk associated with that investment. The greater the risk, the larger the return investors require as compensation for bearing that risk. The rate of return is what you earn on an investment, stated in percentage terms. Risk is a measure of how certain you are that you will receive a particular return. And then the relationship between the two. The greater the risk associated with an investment, the greater the return investors expect. Investors want the highest returns for a given level of risk or the lowest risk for a given level of return.
And so these are the quantitative measures of return. The total holding period return consists of capital appreciation and income. And so these are just equations for them. And so the total holding period return, this is an example. And if Ella buys a stock for $26 after 1 year, the stock price is $29.90, and she receives a dividend of 80 cents. What is her return? And so this is basically the equation for it. You plug these numbers in right here, and then it would be 0.18 or 18%.
The expected return is the weighted average of possible investment returns. For example, the sum of each possible return multiplied by the probability that it will occur. So that's the equation for that. So, for example, there's a 30% chance the total return on the stock will be negative 3.45%, a 30% chance it'll be 5.17%, a 30% chance it'll be 12.07%, and a 10% chance it'll be 24.14%. Calculate that expected return, so that's that same equation from same expected return equation plugged into here.
And so this is variance and standard deviation as measures of risk. So to calculate variance, a measure of risk, square the difference between each possible outcome and the mean, multiply each squared difference by its probability, and sum. And so this is the equation for it, and then you calculate the standard deviation by taking the square root of the variance, which is at the bottom. And so variance and standard deviation example, there's a 30% chance that the total return on a stock will be negative 3.45%, 30% chance it'll be 5.17%, and a 30% chance it'll be 12.07%, and a 10% chance it'll be 24%. And so this is the same numbers, obviously, and the expected return is 6.55%, so we have to calculate the variance and the standard deviation of the returns. And so this is it right there. Plug in the numbers.
The normal distribution is symmetric, and the mean and standard deviation are the only information we need to determine the shape. The mean, the average, is the center and is the reference point to which all other values in the distribution are compared. Values less than the mean are on the left, and values greater than the mean are on the right. The left and right sides are mirror images. To use standard deviation as a distance measure, consider how many standard deviations are between a value in the distribution and the mean. The standard deviation tells us, based on what has occurred in the past, the probability that an outcome will occur. Standard deviation can be used in a context such as the average return on the S&P 500 is 3%. What is the probability of it being between 3% and 1%? When the difference between 3% and 1% is converted to a standard deviation, it becomes a distance. And outcomes that occur most often are closest to the mean. Convert to fewer standard deviations. Outcomes that rarely occur are farthest from the mean and convert to more standard deviations. For a normal distribution, a standard deviation is associated with the probability that an outcome occurs within a certain distance from the mean. 90% of outcomes are within 1.645 standard deviations from the mean, 95% are within 1.96, and 99% are within 2.575. Here's an example of those numbers.
Yeah, and this is just a distribution like this is the regular distribution, the thing that's, dotted. And then this is an example of like a 2%, return for an interest rate or an investment that was made in Miami. It's just an example showing the regular curve and then one that's above it.
And so the historical market performance, on average, annual returns have been higher for riskier securities. Exhibit 7.3 shows that small stocks have the largest standard deviation of returns and the largest average return. On other end of the spectrum, treasury bills have the smallest standard deviation and the smallest average return. And so these are just examples of that. And this is an example of Apple and their monthly return. You can see how much it varies in the S&P 500. And so this is comparing the small stocks, large stocks, long-term corporate bonds, government bonds, immediate term government bonds, and U.S. Treasury bills, and you can see all the difference in the values over time.
Arithmetic and geometric average returns. The arithmetic average return is the return earned in an average period. The geometric average return is the average compounded return earned by an investor. Here's those equations. By investing in two or more assets whose returns do not always move in the same direction at the same time, investors can reduce the risk in their investment portfolios. A portfolio is a collection of assets an investor owns. Diversification involves reducing portfolio risk by investing in two or more assets whose values do not always move in the same direction at the same time. Returns for individual stocks are largely independent of each other and approximately normally distributed. A simple tool for comparing risk and return for individual stocks is the coefficient of variation. Here's that equation.
And so this is the Sharpe ratio. It's a modified version of the coefficient of variation, which measures the return per unit of risk. And so this is it right here. And then the expected return of a portfolio, the coefficient of variation and the Sharpe ratio have a critical shortcoming when applied to a portfolio of assets. They cannot account for the interaction of assets' risks when they are grouped into a portfolio. And the expected return of the portfolio, it's right here. And this is an example of that. So if a portfolio consists of $100,000 in treasury bills, they yield 4.5%, $150,000 in Procter & Gamble stock with an expected return of 7.5%, and $150,000 in ExxonMobil stock with an expected return of 9%. And what is the expected return for this $400,000 portfolio? And so this, you can see right here, the numbers are plugged in. You can see that the weight for the treasury bill is 0.25, and for the weight for the stock is 0.375. And this is plugged in at the bottom, you get 0.0731 or 7.31%. And so this is the monthly return for the Southwest Airlines stock and the Walmart stock, and you can see that the Southwest Airlines stock is getting a higher monthly return than the Walmart stock. And this is the Southwest Airlines, the Walmart, and the 50-50 portfolio, and you can see the difference right there. And this is risk and diversification part 2. The risk for a portfolio of 2 stocks is less than the average of the risks associated with the individual stocks. When stock prices move in opposite directions, the price change of one stock offsets some of the price change of another stock. And so the risk of a portfolio of 2 stocks is right here.
Covariance indicates whether stocks' returns tend to move in the same direction at the same time. If so, the covariance is positive. If they don't move at the same time in the same direction, it's negative or 0. The variance, so here's an example using previous equation. The variance of in returns of the covariance stock, and CSX and Walmart stock are 0.03949 and 0.02584 respectively. Covariance between CSX, and 50% Walmart. So you plug those into the previous equation. Okay. To measure the strength of the covariance relationship, divide the covariance by the product of the standard deviations of the asset's returns. This result is the correlation coefficient that measures the strength of the relationship between the asset's returns.
And so for the correlation coefficient cannot be greater than +1 or less than -1, or else you did something wrong. And the negative correlation indicates that the asset prices move in opposite directions. The positive correlation indicates that the asset prices move in the same direction. Zero correlation indicates there is no linear relationship. So the +1 and the -1 doesn't necessarily indicate that they're moving up or down, it's just that they're moving in the same direction. And the limits of diversification. If assets are not perfectly correlated, risk can be reduced by creating a portfolio using assets having different risk characteristics. And so the limits of this are when the number of assets in a portfolio is large, adding another stock has almost no effect on the standard deviation. Most risk reduction from diversification may be achieved with 15 to 20 assets, and diversification can virtually eliminate risk unique to individual assets, but the risk common to all assets in the market stays the same. And firm-specific risk relevant for a particular firm can be diversified away and is called unsystematic or diversifiable risk. And risk that cannot be diversified away is non-diversifiable or systematic risk. This is the risk inherent in the market or economy, and firm-specific risk is in effect reduced to zero in a diversified portfolio, but some systematic risk remains. And so this is just an example of the total portfolio risk and standard deviations.
Investors do not like risk and will not bear risk. Yet they can avoid by, they do not bear risk, they can avoid by diversification. Well-diversified portfolios contain only systematic risk. Portfolios that are not well diversified face systematic risk plus unsystematic risk. No one compensates investors for bearing unsystematic risk, and investors will not accept risk they are not paid to take. Systematic risk cannot be eliminated by diversification. Competition among diversified investors will drive the prices of assets to the point where the expected returns will compensate investors for only the systematic risk. Here's that plotted. Measuring systematic, if the average return for all assets is used as the benchmark and its influence on the return for a specific stock can be quantified, the expected return on that stock can be calculated. The market's influence on a stock's return is quantified in the stock's beta. If the beta of an asset is 0, the asset has no measurable systematic risk if it's greater than 1. The systematic risk for the asset is greater than the average for assets in the market, and if it is less than 1, the systematic risk for the asset is less than the average for assets in the market.
And just so you guys know, beta is basically the slope of the risk.
And the risk premium is the difference between the market rate of return and the risk-free rate of return. The difference between the required return on a risky asset, RI, and the return on a risk-free asset is an investor's compensation of risk. And so this is the equation right there. And the compensation for risk, the expected return on an investment is a function of the risk-free rate, the beta, and the risk premium. So there's that equation. And the capital asset pricing model describes the relationship between risk and required return for an asset. The graph of the CAPM equation is known as the security market line. The SML illustrates the CAPM's prediction for the required expected total return for various values of beta. The expected total return depends on an asset's current price, and if the expected return is greater than the required return estimated with the CAPM, the expected return will plot above the SML and the asset is considered to be underpriced. And if the expected return is less than the required return estimated with the CAPM, the expected return will plot below the SML and the asset is considered to be overpriced.
A stock has, okay, so for example, that if stock has beta of 1.5, the expected return on the market is 10% and the risk-free rate is 4%. What is the expected return for the stock? Plug those in. And here's what you get once plugged below. The expected return for a portfolio is the weighted average of the expected returns of the assets in the portfolio. The beta of a portfolio is the weighted average of the betas of the assets in the portfolio. Here's that equation, the asset portfolio. For example, you invest 25% of your retirement savings in a fully diversified market fund, 25% in risk-free treasury bills, and 50% in a house with twice as much systematic risk as the market. What is the beta of your portfolio? You plug these numbers into the previous equation. And here's just another example of that.
And now we move on to the homework. This is the homework 7.6. Tanner invested $1,000 in large U.S. stocks at the beginning of 2012. This investment earned 15.98%. In 2012, 32.41%. In 2013, 13.69% in 2014, and 1.4% in 2015. What it's asking you to do is what's the average rate of return per year, and what you do is just take the arithmetic mean or just the average of all the percentages of the portfolio, and you get 15.8%. And for the chapter 7 homework 7.7, it's asking you to look at problem 7.6 and ask what the average annual return that Tanner earned over 2012 through 2015. And for this, you'd use a geometric equation and just plug in all of that, and you get 15.35%. And for 7.11, it's asking you to describe and justify the value of the beta of a U.S. Treasury bill. And basically, all it's doing is holding the value itself. So the beta is 0 because it's holding the value steady while all other different independent variables change it throughout time. So that's why they give you more, because the value may change outside, but it's keeping the value the same inside. And for 7.18, it's asking, Barbara is considering investing in company stock. Is he aware that the return on that investment is particularly sensitive to how the economy is performing? Her analysis suggests that 4 states of the economy can affect the return on the investment. Using the table of returns and probabilities below, find the expected return and the standard deviation of the return on Barbara's investment. So what you would do is you would multiply the probability of return of each different probability, and you would just plug it into this equation, and you'd find that you just plug everything in for the expected return, and for the standard deviation, you would multiply it by what it was for that specific time, and then you square everything, and then unsquare them so that none of them are negative, and you get 8%. And for 7.27, in February 2017, the risk-free rate was 2.97%. The market premium was 6%, and the beta for Twitter stock was 0.99%. What is the expected return that was consistent with the systematic risk associated with the returns on Twitter? So basically, you would plug it into this equation to find the expected rate of return and the risk associated with that. And you would just plug in the risk-free rate, and then you'd add the slope of the Twitter stock, which is 9.9. And you'd also multiply the Twitter stock by the premium, which is 0.6%, and you'd get 0.0891, or just 8.91%. And that's it.
over here, can you move the, can you do the camera on me? Just shoot me for the next 20 minutes.
All right.
Okay, just follow me around. All right, let's do the, we left off, so we already did the derivative trades. Correct if I'm wrong. We get to the derivative trades, where did we leave off? I was told that we already did the derivative.
Yeah.
We did the derivative trade. I didn't do did we do an introduction to forwards and futures for you too, the option?
We went, yeah, we did forwards
Okay,
and
I'll do it
futures.
again on the motion. Okay, we'll get into a little detail so you understand a little bit more about it. So let's do the technical analysis. It's pretty straightforward. So these are the technical analytical techniques. I mean, we're studying corporate finance. That's called fundamental analysis. But we also use technical analysis. We're always looking at trends and patterns because the trends and the patterns are always recurring. So we can spot a trend or we can spot a pattern, and we can predict what the direction of the cash flows, the indicator, the stock price, the bond price, whatever it is we're trying to forecast. So technical analysis can be applied to all kinds of indicators. But we're going to use stock analysis, technical securities analysis. If you're really interested in this area, you can get a certification and you can take courses in it at Golden Gate University. That's one of the best technical analysis programs next to NYU out of New York. There's only two major schools that have the technical analytical certifications in the program, and that's Golden Gate and NYU. So here are some of the techniques that we would use in technical analysis. One is momentum trading. Momentum trading, which basically states if the stock price is upward momentum and trending upwards, what direction is it probably going to go if it's been going up for quite some time? So, really? No, it's momentum. There's serial correlation. So the prior price patterns will give you an indication of what the future direction will be just based off the momentum. It's just based on momentum, not economic factors or internal factors, but just looking at the data. You're looking at trend analysis, so you're looking at the trend lines, either up or down. You're looking at the volume charts. This is the volume, the securities that are traded each day within the security. If everybody's selling, the volume spikes and the stock price goes down. If everybody's buying, the volume goes up and the stock price goes up. So you just look at here, another indicator is just volume charts. The RSI and the MACD, these are moving average. These are also momentum indicators that you can get off the stock charts, com chart. And usually they're up here and down here. These are like moving average or trend lines. So as the trend lines start to move down, the stock price is probably moving down. If the trend lines are moving up, the stock price is probably going to continue to go up. You're basically conducting historical analysis. I like to go back at least 3 years in the price charts. But if the stock price has been careening for some time, I want to see how far the stock price can go down. Based on history. Okay, so it gives you kind of a historical analysis. The other is pattern recognition. Again, the pricing, the way that it moves, all stocks basically, the patterns are all very similar to each other. So if you can apply and recognize certain patterns, then you can predict where the stock price is going to go. You can also build time series regression analysis, where you basically have the price as the dependent variable, and you build a regression model out of it. You can do that too. There are also wedge and flag patterns. The flag pattern, stock price goes up, and then it goes like, basically looks like a flag. And then the wedge is basically the same thing. The stock price goes up, but then it goes like that, and then it goes. So those are price patterns that are easily recognizable when you start analyzing the stock charts. Support and resistance lines, which you'll see is the stock price is going to start trading, and then it'll start bouncing off this bottom. So it's forming a support. Okay, and then the resistance line, as you can see, the stock price keeps like banging up. It can't go any higher. It can't break out to the upside. So it's setting up a resistance line. So you have these support lines and these resistance lines, and you ability to be able to identify supports and resistance helps you in your ability to predict where the stock price is going to go. This totally violates the weak form efficient market hypothesis, because you can't, theoretically, you can't profit from historical data. That's baloney. The efficient market hypothesis weak form has been totally violated because people are out there trading securities based on this technique and they're making millions of dollars. So the market's inefficient. Stocks can also prices can break out to the upside and the downside. If you're forming this support and this resistance and you're in this trading range, all of a sudden news will come into the market. Either the stock price will break out to the upside or it will break out to the downside. This is all technical language that you used if you ever listen to Bloomberg or any of the business news. They all use these terminologies. Dow theory is basically applying the theoretical approach to identifying price patterns and trading rules. And then the more sophisticated one, which is another one that works really well, is the Wyckoff method. I like to use the moving average crossover system because that's the money machine that you can definitely make money on these things. So here's an example of a technical chart. Maybe this is Apple or Cisco or whatever the stock chart is. This is really Yahoo. So the stock price goes up. It trades in this range. This is called, when it's trading sideways like this, it's called trading sideways. It's called a consolidation phase. It's called an accumulation phase. It's also called a trading range. The stock isn't doing anything, it's just trading sideways. Then all of a sudden information will come into the market. It'll break out to the upside. And then as you can see, it formed another resistance and it formed another support line here. In Dow theory, this is called head and shoulders. This is one shoulder here, this is another shoulder here. Here's the head or the peak in the stock price. And this is what happened to Yahoo. Yahoo started blowing it, okay? And then it broke through to the downside from the support, started trading in this intermediate trading range, and then it broke out to the downside and continued to go down. As you can see, the stock price was in an upward trend, and then now it's in a downward trend. That's technical analysis. If you want to learn more about it, you can talk to me, or you can Google it. There's all kinds of really cool trading techniques that a lot of professional traders utilize.
What determines the support line and resistance line?
Really, the support is you're just watching the stock, and it looks like it can't go any lower. There's a support, and then it just keeps bouncing off, at this level, so it forms a resistance.
There's nothing.
There's no information that's coming in, so the market doesn't know what direction it's going to go because there's no fundamental information, either at the firm level or at the macro level. So it just starts trading sideways and starts to trade really thin. The volume starts to shrink, and then all of a sudden news will hit, the volume will spike. Either it'll break out to the upside or break out to the downside, and then it'll start forming another pattern after the information's been internalized into the stock price by the traders. Okay. Any other questions? Yes, sir.
When there's a resistance and a support line, is it because there's a constant change or?
Yeah, well, what happens is, you form the initial support and resistance, then it breaks out, and then it looks like it starts to form another, right? Support lines and then resistance. When Yahoo started to careen, it broke out to the downside through this more immediate support, and then it looked like it was trying to form another support here where the resistance line was prior. You see that a lot. But then the bad news came and Melissa Mayer made some mistakes, and then the stock price broke through to the downside and just continued on a downward trend. And it should have been liquidated at a lower price, but people knew the stock was going to get bought out. So the multiple on the stock, using the multiple approach, continued to be high, and the valuation of the stock continued to stay high, well above its intrinsic valuations. Okay, any questions on the technical analysis? Okay, and then the 4 valuation techniques, intrinsic valuation techniques, there's only 4 that we utilize. There's others, but these are the main ones: the perpetuity, the Gordon growth, the multiple, and the discounted cash flow. And I'm just testing you really on the theory, this is the theoretical piece, and then you work out some problems here. So So the perpetuity model is pretty straightforward. It's basically next year's cash flow. And the cash flow could either be, if you're valuing firms, it's gonna be EBITDA, EBIT, or earnings that you're gonna use. So you always wanna project that out. And you can also use EBIT, EBITDA, EBIT, or earnings per share. If you're gonna value the stock price, you do it on a per share basis. If you're evaluating it at an entity level, then you use the top line cash flows. And it's next year's cash flow. We assume with its perpetuity, it's gonna be a constant, so it's gonna remain flat forever. So it's just the cash flow divided by your expected return, or also called the discount rate. You can use the capital asset pricing model. You're gonna learn about weighted average cost of capital in the second third of the class. It can also be an interest rate if you're valuing a perpetuity bond. And if it's also called a cap rate, or capitalization rate in real estate, if you're gonna use net operating income as the numerator. So it's just a standard valuation method. Okay. The Gordon growth model is basically the perpetuity model, but you're assuming that the cash flows are gonna grow at a constant rate forever. So the equation just decomposes into the future cash flow divided by I minus G. And again, expected return minus the constant growth rate of the cash flow forever. Okay. So that's gonna give you the valuation using Gordon growth. In the multiple approach, again, you're using the same future cash flow, but you're gonna multiply it by a multiple, next year's multiple, to get next year's price. In all of these, you're projecting next year's valuation. You're always valuing further out. So what's the multiple? Well, if I'm valuing a firm, and I know that there's been firms like my firm that's been sold recently, I can observe the valuations in which those firms were sold for. So if they're unicorns, they're selling for $1 billion or $2 billion. Then you divide it by the cash flows of the company to get the multiple in which the deals were transacted at. Well, if I know my cash flow and I know what the multiples are trading at for a firm similar to mine, I can multiply that multiple times our cash flow to get our valuation for the company. I can do the same thing for the stocks. I can take the stock price and divide it by the earnings per share, and that's going to give me the PE multiple. It's going to give me the PE multiple. So if I know what our stock price is going to be in the future, and I know what our earnings per share is going to be, I can calculate a forward PE multiple and apply it by our cash flow to get the valuation for the stock. PE multiples, or multiples, can also be calculated using 1 minus I, which is the perpetuity model, or 1 divided by I minus G to get a multiple. If I do 1 divided by I to get a multiple and multiply it by the cash flow, the valuation is exactly the same as the perpetuity model. If I take 1 divided by I minus G to get the multiple, I can take the multiple, multiply it by the cash flow to get the value, and it's the same value as the Gordon growth. Okay. So Wall Street uses multiples. We theoretically use these models. They're exactly the same, but deal people think in multiple terms. They don't use those, they use the multiple approach. And they also rely heavily on the discounted cash flow or the DCF method. So here's just a 3-year DCF, discounted cash flow. I could either be valuing a firm or valuing a stock. So basically, I'm going to take last year's cash flow and grow it out and use that as this year's cash flow. Okay? And then I'm going to grow it out to the second year and the third year. Then I'm going to take the discount rate or the expected return or the WACC or the CAPM or whatever I'm using, and it's going to be 1 plus I to the 1 to get the discount factor. 1 plus I to the 2, 1 plus I to the 3. Okay. So that's pretty straightforward. But here's the tricky part. Here, the students always have a problem. What I need to do is I need to go 1 more step. And I need to grow the cash flow, the third year cash flow out 1 more year to get cash flow for year 4. And then what I do is I'll apply either the perpetuity model or the Gordon growth model to that 4th year cash flow to get the terminal value. And then I'm going to take the terminal value and I'm either going to add it to the 3rd year cash flow, or I'm going to discount this 4th year, this terminal value, by 1 plus I to the 3. Usually what I do is I just add the terminal value to the last year's cash flow. And then I discount it all back to get the present value. The firm, I can use it for equipment, capital budgeting, I can use it for firm acquisitions, I can use it for stock valuation. It's a standard methodology for discounting cash flows to the present. And then if the value's higher than what I can buy it or build it for, we're gonna do it. Okay? If it's below it, I'm gonna have to reduce the initial cash flows, or I'm gonna have to increase the cash flow. So I gotta go back and underwrite it. We'll do that during the midterm. Okay. How much time do I have?
9.
Okay. See if I can do it. So here's the 3 problems. Now we start moving into the problems. Okay.
Is that right?
We've been mostly doing theory in the class, but you've been doing the homework, so you've been getting some application, problems, and then I threw some problems in on the exams too. Okay. So the first problem, again, is an investment decision-making problem. Triad Owens, a professional athlete, currently has a contract that would pay him a large amount in the first year of his contract and smaller amounts thereafter. He and his agent have asked the team to restructure the contract. The team, though reluctant, obliged. The trade and his agent came up with a counter offer. What are the present values of each of these alternatives below using a 4% discount rate? So, how do you say his name? Tyrade Owens, Mr. Owens. Mr. Owens has a required rate of return of 14%. Okay, so that's what we're going to use to discount the cash flows. So they give you the cash flows, and I put these in, in millions. So I just truncated. I got rid of the zeros just to make the math a little easier. So he's getting 3.1 right up front on this deal, and then he's got the cash flows that are going out. We know that he's, oh, sorry, this is, this is 5.35, I apologize. This is Eric Fisher, #1 draft pick to the Kansas City Chiefs, and his agents are evaluating 3 contract options. Each option offers a signing bonus and a series of payments over the life of the contract. Fisher uses a 10.25% expected return to evaluate the contracts. Given the cash flows of each option, what contract option would he use? So again, he's getting these bonuses, and then we are discounting the future cash flow. So he's receiving the bonus in the first year up front at the beginning of the year, so you don't discount it. Okay? And then he's going to get next year, he's going to get these payments. So then you lay out the payment streams. What I would like to see on the exam is these set up these discount factors, but also actually calculate the discount factors, so that I know that you know how to. You're not just memorizing this. You're actually using the calculator and practicing exponentials. And then you take the discount factors, divide them up into the cash flows to get the discounted cash flows. You add them all up to get the present value of the cash flow or the contract. So option A, he got 6,923,000, and option B, he got 6,984,000, and in option C, he got 7,084,000. So which option would he pick? C, because it has the highest present value. So these are not rocket science; they're just exercises. And then the second one is the same thing. There's a current contract, there's a team offer, and a counter offer that's somewhere in between. So there's no bonuses on this one. It's just pay on the contracts. So again, here's your discount rates and your expected returns. You calculate the discount factors. They already give you the payment stream. You discount the payment streams for each of the individual years based on the individual discount factors to get the discounted cash flows. You add them up to get the present value of the current contract, which is $12,847,000. The team's offer present value on that one. The present value came out to be $11,374,000, and then the counter offer was basically somewhere in between the $14,519,000. So you would take obviously you would take the counter offer because it gives you the most. Okay. So So that's how we do it, if we're doing contract negotiations, or if we're working, us as financial people working, on legal teams, we'd be calculating these kind of present values depending on if we're the plaintiff or the defendant within some of these cases. Okay. And then the next problem is basically a stock valuation. Given the following information for Capstone Corporation, what price would CapM predict that the company's stock price will trade for 1 year from today? We assume that the risk-free rate is 3% and the market risk premium is 8%. The beta is 0.65. The current stock price is $64.61, and the annual dividend is $1.92. So the first thing you do is you calculate the expected return on the stock using the capital asset pricing model. We know what the market risk premium is, 8%. We know what the beta is, and we know what the risk-free rate is. So we can just do the calculation, and we get an 8.2% expected return using CapM. Then you set up the, we're trying to figure out what the price is. So we've got the return, we already know what that is. Then we're gonna take next year's price, which is what we're trying to forecast. We know the current price, and we know the current dividend, and we know the prior price. So basically, since we have the return, we can plug in the numbers. P1 is the unknown, minus the $64.61 plus the dividend, which is $1.92, divided by the $64.61. Then you just set up the equation, right? We're going to want to move this over here, right? And then we have this. So the only thing that's left is P minus the price plus the dividend. We move all of that stuff over to that side, and basically we can calculate just through the algebra, we can calculate the stock price. So our forecast for the stock price based off of the expected return calculated using CapM, or the capital asset pricing model, is $67.99. Okay. And then the next one is basically a bond calculation. Now, it's a 10-year bond semi-annually, so it would probably be wrapping around your page. So the easiest thing to do is to just use the future value of an annuity calculation on the payment side. Okay. So here's the equation here. So you got the coupon, you know what that is. It's 8% times the $1,000 is $80. And then the interest rate that we're going to use is we're going to use the 6%, which is here. So this is annualized. And then the equation is 1 minus 1 divided by 1 plus I to the n divided by I. So this, what you're really doing here is you're calculating a multiplier, is what you're really doing, based on the annuity. And then this is just the discounted cash flow of the future value of the bond, which is $1,000. So you plug all of this in, you get this piece, which comes out to be $588.81. You discount that one, $1,000, it multiplies those 6 to the 10, you get $558,031. You add them together and you get the price of the bond of $1,147.20. The next one, how much time do I have? Okay, just really quick. This next one you got to think about. Okay, the bond is trading at a discount. Okay, at a discount from par. Par is $1,000. It's trading at a discount. Test question: is the market interest rate higher or lower than the coupon rate? It's trading at a discount. If it's trading at a discount, is the market interest rate higher or lower than the coupon interest rate?
Lower.
Okay, if the market rate is lower than the coupon interest rate, then the bond trades at a premium. If the market interest rate is exactly the same as the coupon rate, the bond trades at par. If the market interest rate is higher than the coupon rate, the bond trades at a discount. So the question is this bond trading at a premium, par, or a discount? Discount. So the market interest rate has to be higher than the coupon rate. What's the coupon rate? 6%. So what you have to do is you have to project out the cash flows and then go 6%, 7%, 8%, 10%, 10%. Oh, 10%. I'm using a 10%. I discount the cash flows for the bond. I come up with $868.43. Therefore, my yield to maturity on the bond is 10%. Okay. That's through interpolation, but I sent you the calculator steps. If you want to show me the calculator steps and calculate it using the calculator, bam, I'll take it. And then the next two problems are pretty straightforward. We'll finish those in
And you said if the market rate is lower than the coupon
If
rate.
the market rate is lower, then the bond trades at a premium about $1,000. If the market rate is higher than the coupon rate, then the bond trades at a discount below $1,000. So that's really the key to that problem, is that logic. Thanks for coming. Thanks for eating my cookies. Here's some chocolate.
Career, internship, and grad school fair. I haven't, no, I went to a grad school fair thing last night. It could be similar, but it didn't have the career and internship. Pretty good, dude. Yeah, I can't go
I have
to
a
the.
scholarship.
I'm just not sure.
Are you 21?
Yeah.
When are you gonna be 21?
Probably not.
Perfect. You're gonna be 21.
Awesome.
Yeah.
Thank
And
you.
if you're interested, I want to put you on it, and I'll help you. And then your total.
They probably just meant as reschedule, because they just didn't know how to take off their system.
Yeah. Oh, awesome. It's, it has to be done too. Yeah. Can you do one for me in one page? To take all this stuff out, let's do the college here. And then, why don't you and I sit down and we can refashion and put together a one page.
Next class or?
Why don't we do it, can you come out of the office? Yeah, I'm 8 to 9 and 1:30 to 6.
On your office, or?
Yeah, 301 Bellman.
What is it?
This is, are you 21? Okay, this is a scholarship to Urban Land Institute. They'll basically take you on tours, you'll meet a bunch of people in real estate, you'll go to events. It's really awesome. Do you need sponsorship? Student sponsorship?
Yeah.
Let's talk about that. We might be able to work it out.
Okay.
We'll see. But we're gonna need you to get take the scholarship.
I just wanted to let you know that I'm not gonna be here on Tuesday.
Next Tuesday?
Yeah.
Uh,